Hi there, welcome to the Stockscores Market Minutes for January 31st, 2014. This week I'm going to talk about doing market scans for the long-term trader. The trader should adjust the chart time frame and market scan settings to suit the time horizon for their trades. Obviously, a day trader is going to use the market scan tool in a very different way than a long-term trader who wants to hold stocks for months or even years. How often do you want to check your stocks? Do you want to look at stocks hourly, daily, weekly, monthly? Answering this question will allow you to then determine the type of chart setup you look at on Stockscores.com, as well as how you use the market scan tool. The philosophy, however, is always the same. We want to look for stocks making abnormal price moves from predictive patterns, but do so in the time frame that fits your goals. Now, I like to utilize the price gain filter on the market scan as well as the sentiment stock score when I'm looking for longer term trades, and that is using the weekly or even monthly charts to find those trades. Now, if you want to be that trader who looks at the market perhaps only once a month, then set your chart to a 10-year monthly chart and look for gains using the market scan of more than 10% over the last 20 days with sentiment stock score greater than 60. In other words, we want stocks that in the most recent month are up at least 10%, and by using the sentiment stock score, we're also looking for stocks with optimistic charts. Now, if you are willing to look at a chart a little more often, perhaps every week, then set your chart default to a 3-year weekly and look for gains again of more than 10%, but this time over the last 10 days, also with the sentiment stock score greater than 60. Now, I want to quickly walk you through the process to do this. We are on Stockscores.com now, and the first step that I need to do is change my chart default. So the default chart that I have right now is a daily chart going back 8 months. If we make this instead a monthly chart going back 10 years, we're going to get a very long-term view of the market appropriate for that trader who doesn't want to look at stocks on a constant basis. So I've done that now, and we're going to see here a 10-year chart of the stock I was looking at, Suncor Energy. But what I've also done is reset my default, because now any stock that I pull up will be a 10-year monthly chart. Now, some stocks we may not have 10 years of history. Not all stocks have traded in the last 10 years. For example, if I punch in Twitter, which just started trading in the last 3 months, you can see the chart shows a 3-month chart. That doesn't matter, however, because the next step that we're going to do is use our market scan tool to look for those things that I talked about. Now, I'm going to look for stocks that are up at least 10%, so I use the gain-loss criteria over the last 20 trading days. I'm also going to set a minimum number of trades of at least 1,000 so that I get stocks that are fairly liquid. Now, you can play with that. You can also set a price range. If you only want stocks over $5, for example, you could do that. So let's in fact add in price greater than $5, sentiment score at least 60, and now run that scan, and it's going to go through every stock that trades in North America, and it found 67 that meet those basic criteria. Now, my last step is to inspect the charts to see if they have predictive chart patterns. Now, I teach my students how to read chart patterns, and there's certain things we look for. For example, this chart here for Shanda Games is not a great chart, but pretty good. I rate it a 6 out of 10. I can continue to cycle through the charts in the gallery chart viewer, looking for stocks that are breaking from low volatility and from optimism. For example, this particular stock here, Pacific Biosciences of California, gave us a pretty good buy signal 6 months ago when it broke from very low volatility with abnormal price action from a rising bottom. Those are some of the things that I teach traders to look for. All right, let's get into the market action and the charts for the week. To start off this week, we've had a pretty substantial sell-off, over 300 points on the Dow, and that breaks the medium-term downward trend, which we've been talking about as support for the last couple of weeks. So this is a sign from the market that it is likely to move lower. Now, the only caveat that we have to put on at this point is that we are only on the first day of the week, and this is a weekly chart. So really, until Friday comes, we don't know that this is a true breakdown on the weekly chart. However, based on Monday's trading action, it does look like that medium-term trend has been broken, and that means we are likely to fall to the longer term trend, which has a, if you extrapolate out with some time, at about a price of about 165 on the SPY. So that's another 4 or 5% down from here, and I think that that is the probable outcome. Typically, when you see a break like this from a new high, you usually bounce back first. So my short-term outlook is we could see more weakness right away, but I think that it'll probably bounce a little bit, make a falling top, and then continue lower. Either way, you want to be relatively cautious with the market in the near term. The TSX has not broken its upward trend line, but certainly that could happen in one day very easily, so you need to keep an eye on there. The TSX is benefiting from the fact that it has got a lot of commodity stocks, and there does seem to be some rotation out of sort of the high-flying tech names and into commodity stocks. So the TSX has a good chance to outperform here in the near term. If the S&P goes down a lot, this will probably go down a lot as well. But it is a positive that the market, the Canadian market, should benefit from that rotation out of the high-flying stocks. Treasuries, flight to safety, going up, breaking through some resistance. That's a positive for people that want to buy mortgages, companies that want to borrow money, that sort of thing, because as the bond market goes up, interest rates go down. The emerging markets have fallen to their support area, and we should see a bounce here, but of course if that line is broken, then further downside is likely. You could probably make this line a little more lenient than I have. I've drawn it across candle bodies. You could probably drop that down a little bit, but either way it is getting into the danger zone where it may be breaking down from its lengthy sideways consolidation pattern. The US dollar was weak today, but generally speaking is in a pennant formation at the bottom of a downward trend, and that is on the bearish side of neutral. So the outlook for the US dollar is lower prices until the top of that pennant, which is the green line that I've drawn, gets broken. And finally, well, not finally, but one of the important charts to keep an eye on is gold, because as markets sell off, often there's a flight to safety into the so-called safety of gold. It has broken its downward trend line 3 weeks ago and is now trying to confirm that break. Last week it couldn't do that. This week so far it's trying to. I do get a sense though that there is some money coming into the gold stocks, primarily because the valuations are pretty low, and the valuations on some of the tech names and some of the industries that have been leading the market are pretty high. So it could just be a sector rotation, but also the fact that gold itself is getting better. Oil remains stuck in that long-term sideways trading range. I don't really see much reason to get too excited there, but again, oil stocks are benefiting from a rotation out of the leading sectors and into some of the weaker sectors, including energy. The VIX had a big jump today with a 300 plus point drop on the Dow. That's to be expected, and it does look like fear is picking up with the options premium in the futures for the S&P 500. So these are signs that investors are getting nervous, and that coincides with that break of the upward trend line on the overall market. So I'm lowering my rating on US stocks to neutral in the long term, bearish in the short term. I do think that we've got further to fall. But again, as I said, wouldn't be surprised if we see a bounce back in the near term, forming that falling top before we break down. Canadian stocks remain bullish, but right on the edge because we are at the upward trend line. Bearish short term because of the recent weakness. Gold is neutral on both short and long, but I do see money coming into the gold stocks, and that is a positive for the Canadian market. Oil neutral on both accounts in terms of the actual commodity, but again, the energy sector is actually holding up better than most. The U.S. markets have broken their medium-term upward trend line and are likely to see further weakness in the weeks ahead, although a short-term bounce back is possible. Gold is attracting some money seeking safety, but has an uphill battle. Oil is stable. The Canadian market should benefit from a rotation into commodities. That has been the Stockscores Market Minutes for February 3rd, 2014. Have a great week in the market and trade well.